Right now, there's a huge disconnect in the market. On one side, you have regular investors pulling back, sitting in cash, waiting for clarity, and assuming the next big move is probably down. On the other side, you have some of the most sophisticated investors in the world quietly putting capital to work. And when that gap gets wide enough, it usually matters. Because the market doesn't reward comfort. It rewards positioning. At the moment, fear is everywhere. Headlines are dominated by geopolitical tension, inflation concerns, slowing growth, and serious doubts about whether the AI boom will actually produce the kind of profits investors have been pricing in. But here's the part most people miss. Smart money usually doesn't wait for the headlines to feel safe. It moves while uncertainty is still high. And if you look closely at where large institutional portfolios have been leaning, 3 areas stand out. Not 10, not 20, 3. So in this video, we're going to break down where smart money appears to be concentrating, why these areas make sense in this environment, and what that could mean for investors who are still frozen on the sidelines. And trust me, the third one is the one most people are not paying enough attention to. Now, before we talk about opportunity, we need to acknowledge something important. The fear is not made up. Investors actually do have real reasons to be cautious right now. Consumer sentiment in the U.S. has weakened again. Bearish sentiment among individual investors has been running unusually high. And at the same time, an enormous amount of money is sitting in money market funds instead of being deployed into risk assets. That tells you the same thing in 3 different ways. People are nervous, they don't trust the outlook, and they'd rather earn a safe yield than take market risk. And honestly, you can understand why. Oil prices have become a source of renewed inflation pressure. Growth looks softer than many expected. And even though AI is still the dominant long-term theme, more investors are beginning to ask a hard question. What if the spending is real, but the returns take much longer than the market expects? That's a serious question. Because history is full of powerful technologies that changed the world while still destroying capital for investors who bought the wrong layer of the story. So yes, fear makes sense. But that doesn't mean the right move is hiding. It means the right move is figuring out what the most informed capital is doing while fear is still high. So where do we look for that? One of the best places is institutional portfolio disclosures. Every quarter, large money managers disclose major equity holdings. And while those filings are backward-looking, they still reveal something incredibly valuable. Not what investors say on television, but what they were actually willing to own with real money. And when different investing styles start leaning in the same direction, that becomes interesting. Because macro funds, value investors, concentrated activists, and high-conviction hedge funds rarely agree for the same reason. So when they begin clustering around similar themes, that's not noise. That's a signal. And right now, the pattern looks less like broad optimism and more like selective accumulation. Smart money is not buying everything. It's being very specific. The common thread is simple. Own the bottlenecks. Own the cash flows. Own the assets that still matter even if the macro stays messy. That brings us to the first sector. The first sector is artificial intelligence, but not the flashy version most retail investors chase. Not every app, not every software promise, not every company that adds AI to a slide deck. The smarter positioning appears to be higher up the supply chain, in the infrastructure layer. That means semiconductors, memory, compute, networking, and the foundational hardware required to keep the entire AI build-out moving. Why does that matter? Because even if the market eventually realizes that some AI products are overhyped, the physical build-out still has to happen first. The servers still need chips. The training clusters still need memory. The data centers still need hardware. And that's why this part of the trade keeps attracting serious capital. Bridgewater's latest positioning showed a major increase in NVIDIA exposure, while Appaloosa's latest disclosed holdings kept Micron among its top positions. That tells you something important. Sophisticated investors may be less interested in predicting which end-user AI application wins, and more interested in owning the companies that sell the picks and shovels to the entire ecosystem. That's a much cleaner thesis. You don't need every AI business to succeed. You just need the spending cycle to continue. And as long as hyperscalers, enterprise platforms, and sovereign projects keep racing for compute capacity, the infrastructure suppliers remain in the flow of capital. This is one of the biggest mistakes retail investors make in every boom cycle. They chase the story at the surface. Smart money often buys the layer underneath it. The toll roads, the suppliers, the bottlenecks. That's where the first opportunity appears to be. The second sector is financials, and this one is more important than most people realize. Because when investors hear financials, they often think of slow growth, credit risk, regulation, or the scars left behind from prior banking stress. But smart money looks at the sector very differently. It asks, which institutions are still throwing off real cash flow? Which businesses benefit if policy becomes less restrictive? Which platforms can keep compounding even if the market leadership broadens out beyond megacap tech? That's where the financial sector becomes interesting again. Recent portfolio tracking shows that Pershing Square's disclosed U.S. equity portfolio had financials as its largest sector allocation. Berkshire Hathaway also remains deeply exposed to financial and insurance-linked businesses through long-standing major positions. That doesn't look like a group preparing for financial collapse. It looks more like patient capital staying anchored to businesses with scale, pricing power, and durable balance sheet economics. And there's a second layer here that matters a lot: payment rails and financial infrastructure. This is why certain investors continue to favor businesses connected to transaction processing, insurance, and capital circulation rather than purely speculative growth. When the market gets uncertain, investors stop paying up for fantasy. They start paying up for resilience, for recurring revenue, for embedded market position, for businesses that still matter whether the S&P has a good quarter or a bad one. That's why selective financials can become a quiet smart money trade. They don't need hype. They need functionality. And in messy macro environments, functionality gets repriced upward. Now here's the third sector. And in my view, this is where the market still hasn't fully connected the dots. Energy, power infrastructure, and hard assets. Most people think of energy as yesterday's story. But in this environment, it may actually be becoming tomorrow's bottleneck. Why? Because the market is obsessed with digital transformation, but digital transformation still runs on physical systems. AI runs on electricity. Data centers run on electricity. Industrial reshoring runs on electricity. And if power demand rises, while grid constraints remain real, the companies tied to generation, fuel, transmission, and energy resilience become more strategically valuable. This is where the theme gets bigger than oil alone. It becomes a story about national infrastructure, about energy security, about reliability. And on top of that, you have the hard asset angle. When investors become more skeptical about fiscal stability, inflation persistence, and the long-term purchasing power of cash, capital often starts looking for real assets that can't simply be printed away. That's part of the reason gold-related exposure and broader hard asset thinking keep returning to the conversation whenever macro stress intensifies. So this third sector is really a three-layer trade. First, a bet on rising power demand. Second, a bet on energy system scarcity. Third, a hedge against policy, debt, and inflation uncertainty. And if you think that sounds too old economy, remember this. Some of the most modern trends in the market still depend on the oldest inputs in the economy. If the future is more electric, more digital, and more compute-intensive, then power itself becomes an investable thesis. That's what a lot of people still haven't fully priced in. Now let's zoom out. Because none of this matters if there's no historical pattern behind it. And there is. Markets have a long history of creating their best setups when sentiment is weak, but capital under the surface is already rotating into quality, scarcity, and strategic assets. That's the pattern. Not euphoria first. Positioning first. The crowd usually wants proof before it commits. Smart money usually wants price, asymmetry, and a margin of safety before the crowd gets comfortable. That's why major opportunities rarely feel obvious in real time. They feel uncomfortable. They feel early. They feel like you're missing something. And that's exactly why they exist. Even AII describes its sentiment survey as a contrarian indicator. In other words, extreme pessimism has historically been something investors watch not just as a warning sign, but as a potential setup for stronger forward returns when fear gets overextended. So no, this doesn't mean every stock in these sectors will work. And it definitely doesn't mean risk disappears. What it means is that when retail sentiment gets very negative, it often pays to study where high-conviction capital is moving instead of simply copying the emotional tone of the headlines. So let's bring this together. While the average investor is still focused on fear, uncertainty, and waiting for the all clear, smart money appears to be leaning into three very specific areas. AI infrastructure. Because even if the hype gets cut back, the physical build-out still needs chips, memory, and compute. Financials and payment rails. Because in uncertain markets, durable cash flow machines start to matter more than speculative narratives. Energy, power, and hard assets. Because the future still needs electricity, and macro stress still drives demand for real-world scarcity. That's the real message here. This is not blind optimism. It's selective conviction. It's not about buying everything. It's about recognizing that when fear is elevated, the best opportunities are often hiding in the places where capital is quietly concentrating before the headlines catch up. And that may be the biggest advantage serious investors can build right now. Learning to read positioning, not just emotion. If you got value from this breakdown, subscribe to Matt FinLab and let me know in the comments. Which of these three sectors do you think has the most upside from here? And more importantly, which one do you think the market is still underestimating?